In Chapter 22, we're going to take a look at accounting changes and errors. So there's three types of accounting changes. The first is a change in principle. This is when a company adopts a new standard under GAAP. It could be that the FASB changes the required accounting for something, or a company could switch from one acceptable method under GAAP to another method. So, for example, a company could switch from LIFO to FIFO or to average cost for inventory valuation. Change of principle, however, does not include adoption of a new principle and recognition of events that occur for the first time. Second type of accounting change is a change in accounting estimate. For the most part, a change in accounting estimate means that a company is going to be using the same method, but will change an assumption within that method. For example, if we're using straight line depreciation and we decide to change the useful life or the salvage value, then it's considered a change in estimate. An exception to this is if we change depreciation methods. So let's say a company changed from straight line to, say, double declining balance. This is considered a change in accounting estimate. The idea here for depreciation is what depreciation really represents. Depreciation is just an estimate of when the future benefits of an asset will be consumed. So we're allocating expense to try to match up with the revenues reported in that period. So if we change depreciation methods, we're ultimately just changing an estimate. And then finally, the third possible change is a change in reporting entity, which just means that a company is going to change subsidiaries that are included in its consolidated financial statements. So when a company owns more than 50% of another company, it has to report consolidated financial statements with that company. So if a company changes subsidiaries, it has a change in reporting entity. All right, in this chapter, it also deals with error corrections. So error corrections, so an error could be made for a mathematical mistake. Maybe they forgot to make an adjusting entry. Maybe they made the wrong entry. Or maybe they're just using outright the wrong principles or engaging in fraud. Whatever the case, when there's a mistake, hopefully they should be fixed. So in this chapter, we're not going to focus on error corrections or how to account for a change in reporting entity. However, we will cover how to account for a change in accounting principle and a change in accounting estimate. Now, to account for changes or error corrections, there's two main approaches we could take: a retrospective approach or a prospective approach. Retrospective just means we're going to take the accounting change and we'll apply it to any prior periods. This will make it seem like we've been using the new method that we changed to all along, which helps to preserve comparability. Since we're going to go back and restate prior periods, that means we're also going to need to make an adjustment to our retained earnings for the earliest year presented in the financial statements. Right, so if you recall, we close out all revenue and expense accounts into retained earnings. Right, so since those accounts have already been closed out, we need to adjust retained earnings. In the current year, then, we're just going to use this new method. So the retrospective approach requires that when we account for this, we need to have a good understanding of how the standard or the accounting for a group of transactions affects the financial statements. This is probably the most difficult part of handling accounting changes. Now, the second approach we could take is a prospective approach. This approach tends to be straightforward and relatively easy to implement because we'll just make the change in the current period and any future periods. So we don't need to go back and revise anything or make adjusting entries for past periods. Now, of these two approaches, the retrospective approach tends to be more favored because we're trying to provide useful information to investors and creditors with the financial statements. So if we go back and change everything, it allows investors and creditors to better compare a company's performance over time. However, even though the retrospective approach is favored, it's not always practical. So when using the retrospective approach is impractical, we're just going to use the prospective approach. For example, if a company switched to the LIFO inventory method from, say, FIFO, it's handled like a change in estimate because it's impractical to go back, or sometimes even impossible to go back and recalculate multiple inventory layers. Right? That would require the company to probably make a bunch of subjective assumptions. So companies are allowed to just use the prospective approach when they switch to the LIFO method. Another example of this is a change in estimate. Changes in estimates are handled prospectively. The idea here is that in accounting we use a ton of different estimates. So these estimates, as the company gets more information, are going to change quite a bit. So it'd be impractical for GAAP to require companies to apply the retrospective approach when they handle changes in estimates quite often. So this next slide just summarizes how we treat changes in principles, changes in estimates, reporting entities, and so on. All right, so changes in principles and changes in reporting entities will be handled retrospectively. A change in estimate is handled prospectively, and for the most part, accounting errors are also handled retrospectively. Again, we're not going to focus on accounting errors and changes in reporting entities in this chapter. We will, however, focus on the first two, a change in principle and a change in estimate. All right, so for a change in reporting entity, you just need to know it's handled retrospectively. And then same thing for accounting errors. We'll talk a little bit about accounting errors on the very last slide of this chapter, but again, we're not going to focus on it. So we'll start with a change in principle. Again, for a change in principle, we need to make a retrospective adjustment to the accounting records. So we need to go back and make it seem like we've been using the new principle all along. To do this, obviously, we'll need to have a good understanding of the accounting in the area that was changed. For example, if we change inventory methods, we need to understand how all of a company's accounts are influenced by inventory costing assumptions. We'll go over an example of that in just a bit. Second, after the company adjusts the accounting records, they also need to disclose several things to investors and creditors so that these users know what's going on. So, for example, they'll disclose what principle they changed to, and then also they need to have a reason why. Second, they should explain how they applied the change and how these changes affected the financial statement items. And then finally, as we mentioned earlier, if we change all these financial statement items, a bunch of revenue and expense accounts would have been closed into retained earnings in prior years. So the company would also need to disclose the cumulative effect on retained earnings for the earliest year presented in their financial statements. So just to show you an example of the disclosures that will be made, these excerpts were taken from Eastman Kodak's financial statements in 2006. So this is a look at their notes to the financial statements. Right, so in 2006, Kodak changed from LIFO to average cost for inventory methods, and the reason they gave is it better matches expenses with revenues. So in these notes on the slide, they're explaining what method they changed to, why they did it, and how they made the change. So as we'll see in a bit, a change in inventory method will end up affecting our ending inventory balance, and as a result, it also ends up affecting cost of goods sold. So this slide is showing how Kodak's disclosing how their ending inventory balance and cost of goods sold changed. So notice here that even though this change was made in 2006, a company will generally report what are known as comparative financial statements. So in other words, even though Kodak will report the financial statement for 2006, here they're also reporting information for 2005 and for 2004. Right, so Since Eastman Kodak is reporting also the past 2 years of financial statements, it needs to report adjustments for the earliest year presented, which is in this case 2004. And then finally, since a change in inventory method will affect cost of goods sold, that means the change will also affect their income statement. So here, Kodak showing an adjusted income statement to show the effect of the change over to average cost. So the slide just shows the changes for 2005. Here they're just adjusting each item line by line for the change in cost of goods sold. The company also disclosed how their income statement in 2004 changed, but I just didn't include that in the slides since you can get the point from the slide. So let's take a look at an example. At the beginning of 2015, GoPro changed from LIFO to FIFO. Ignore income taxes for the moment. Retained earnings on January 1st, 2013 was $1,700 million. Inventory was $400 million. Assume that GoPro reports 2 prior years of comparative data in its financial statements. So in this case, we're switching from LIFO to FIFO and we're ignoring income taxes. So in other words, we are changing the inventory cost flow assumption. So if we understand how the accounting change affects the financial statements, this will be much easier. So before we get into the details of the example, let's just think about the big picture. So hopefully you remember from 301A how inventory costing methods affect the financial statements. So how they'll affect them is we'll go back to a formula that hopefully you've seen before. So you take your beginning inventory. To that, we'll add our purchases. And if we add our purchases to that, we'll get out to goods available for sale. Let's abbreviate with GAFS. And then from that, if we subtract out our ending inventory, we get to cost of goods sold, or COGS for short. We could just slightly rearrange this. So if we took out cost of goods sold from goods available for sale, it also gets us to ending inventory. Right, it's all saying the same thing because this formula is in a sense circular. Right, so from this we can figure out how the inventory cost flow assumption affects the financial statements. So in effect, the inventory cost flow assumption determines out of our goods available for sale, which goods are considered to be sold and which goods are considered to be our ending inventory. So directly, the inventory cost flow assumption will directly affect cost of goods sold and ending inventory. Now, ending inventory is a balance sheet account. It's a permanent account, so we will be making adjustment directly to the ending inventory account. However, cost of goods sold goes onto your income statement. Again, all of your income statement accounts are temporary accounts, so they'll get closed out at the end of the period. So since cost of goods sold gets reported on the income statement, it's going to affect your different subtotals like income from continuing operations, income before income taxes, and then down to net income. However, again, because the income statement accounts get closed out into retained earnings, and net income will just summarize what happens on the income statement. This means then we're going to end up adjusting retained earnings for the effect that cost of goods sold has on the income statement. All right, so effectively, we'll be making adjustments to 2 accounts when we make the retrospective adjustment. So we'll retrospectively adjust our inventory and our retained earnings. Now, even though we're just retrospectively adjusting inventory and retained earnings, for disclosure purposes, since we have to show how our different financial statement accounts change from the earliest year presented in the comparative financial statements, for disclosure purposes, how we account for this retrospective change will be a little bit more complicated. All right, so we still have to adjust the earliest year in the comparative financial statements for the change. All right, so we'll start with first by bringing our accounting records up to date, and then we'll cover how we change our financial statements to present them. So this slide just gives the original numbers originally reported when the company was using LIFO. As we mentioned on the previous slide, inventory costing directly affects cost of goods sold and ending inventory balance. So we need to see how switching from LIFO to FIFO would affect these two accounts, and then we can start adjusting them. So if the company, this slide just shows how the company's cost of goods sold would change if they went back and applied FIFO to previous years. So notice here that cost of goods sold under FIFO is decreasing under each year in this example. So for the years before 2013, cost of goods sold was originally reported at $1,800. If the company had used FIFO, it would have been reported at $1,650. So we have a decrease of $150. In 2013, the change in accounting principle would decrease cost of goods sold by 30, and then in 2014, it decreases by 20. So in this example, in total, our cost of goods sold had decreased by 200 in previous years. At this point, we really have all the information we should know to make an adjusting entry. If cost of goods sold decreased by 200, this would imply that our ending inventory in previous years would have increased by 200. And so how we know that is from this formula up here. So I'll just carry this down. And so the idea here then, if cost of goods sold decreased by 200, this implies that ending inventory must increase by 200. The reason why is ending inventory is just goods available for sale minus cost of goods sold. So as cost of goods sold decreases by 200, ending inventory must increase by 200. So since ending inventory it needs to be increased by 200, to make an adjusting entry for that, we would debit inventory for 200. For cost of goods sold, we can't credit cost of goods sold to decrease it by 200, because again, the cost of goods sold here is our total cost of goods sold in previous periods. Again, cost of goods sold is an income statement account, so it would have been closed into retained earnings. All right, so in previous years then, if cost of goods sold is decreased by 200, that means in previous years, net income would have increased by 200. And so that also then implies, since net income will get closed into retained earnings, that retained earnings increases by 200. So to increase retained earnings up by 200, we're going to make a credit here to retained earnings for that $200. So this is our adjusting entry here for 2015 when they make the change to the accounting principle. After we've made the adjusting entry, we then need to deal with how we disclose this change. So for disclosure purposes, we just need to keep track of how this change affected our accounts for the earliest year presented in the comparative financial statements. So in this example, before 2013, cost of goods sold went down by 150. Right, so if cost of goods sold went down by 150, that means net income would have increased to 150, and so in turn retained earnings up by 150. So this is just kind of paralleling, if that's even a word, what's happening up here. In 2013, cost of goods sold goes down by 30. Net income is going up by 30, so retained earnings needs to be adjusted up by another 30. And then in 2014, right, cost of goods sold went down by 20, which means net income in that year needs to go up by 20, and our cumulative adjustment to retained earnings needs to go up by another $20. Okay, so again, for restatement purposes, we'll adjust our financial statements for the earliest year presented in the comparative financial statement. Okay, so in this case, up top, we have our original numbers as reported. So notice here under our original numbers, 2014 cost of goods sold of $300, $280 for 2013, $1,800 for before 2013. Right, cost flow assumption won't affect our revenues, and it won't affect our other operating expenses. Right, so when we go to report in 2015, if we report our prior years, notice here, since cost of goods sold went down by 150 before 2013, we're just showing the new cost of goods sold number under the new basis. So we'll reduce this 1,800 by 150 before 2013. That gets us out to the 1,650. Same thing in 2013, cost of goods sold went down by 30. So we're going to decrease our original cost of goods sold from 280 down by 30 down to 250. And then we'll do the same thing in 2014 for this $20 decrease. Next, we can determine adjusted retained earnings. Remember that retained earnings is the accumulation of net income over time that has been retained within the firm. So if we want to figure out our adjusted retained earnings balance in each year, we need to calculate the cumulative or total change in net income over all previous years. Right, so off on the right side, we have our retained earnings before 2013. Right, it was originally reported at $1,700. So before 2013, cost of goods sold would have went down by 150. Net income's going up by 150, so retained earnings goes up by 150. So we'll just add this 150 balance for the increase in net income to retained earnings to get to our new balance of 1,850. In 2013, our balance originally reported was 1,900. Again, to figure out ending balance in 2013, we need to take the cumulative change in net income over all previous years. So in 2013, net income increased by before 2013, net income increased by 150, and then in 2013, net income would have increased by 30 because cost of goods sold went down by 30. So in total then, for 2013, we're adding the 150 adjustment for 2013, the adjustment in 2013, that gets us out to 2080. And then we just follow a similar process for 2014. Again, we're including all previous changes in net income. So before 2013, in 2013, and the $20 increase in 2014. Now the last balance sheet account affected by a change in inventory costing is ending inventory. Again, these changes in ending inventory won't directly correspond to the changes in cost of goods sold because as we went over, if cost of goods sold changes, that means ending inventory must change in the opposite direction by the same amount. So at the top of the slide again, we're looking at the same table as on a previous slide showing what the differences in cost of goods sold were. Right, again, if cost of goods sold decreases by 150, that means ending inventory before 2013 must also increase by 150. So if we originally had inventory of 400 prior to 2013, we need to add 150 increase to that to get to the 550. Right, same thing in 2013. Inventory was originally 450. So since cost of goods sold went down before 2013 by this 150, we need to increase by this 150 increase in ending inventory. To capture the change in 2013, cost of goods sold went down by 30, so then ending inventory must also increase by this 30. And so that gets us to this ending inventory of 630, and then in 2014 we follow a similar process. Ending inventory must increase by the cumulative change in cost of goods sold in any previous period. So we're adding the 150 before 2013, adding the 30 in 2013, and adding the $20 increase in 2014. So the last thing we need to go over for this example is how to present a adjusted retained earnings statement. Again, for disclosure purposes, we're going to present or show the cumulative effect for the earliest year presented in a comparative financial statement. So earlier for this example, we said that for GoPro, they'll present the last 2 years. All right, so again, the top part of this slide just shows our original retained earnings and then our updated numbers for retained earnings. When we go to present this on the balance sheet or on the retained earnings statement, we're again going to report beginning retained earnings as reported for the earliest year presented. So for us, that'll be 2013. Again, in 2013, cost of goods sold would have went down by 150. Net income went up by 150. So we would have to adjust the retained earnings balance at the beginning of 2013 up by 150. All right, so that's all we're doing here. So you'll present your beginning RE as reported. You'll add the adjustment for the change in accounting method or principle of 150, and that gets us out to our adjusted balance. Now after this, we're going to add net income. Our net income here that we're using is the adjusted net income after we change the accounting principle. All right, that'll get us out to our ending RE. And again, this is already the adjusted amount since we've included the adjustments previously. Going into 2014, since this ending RE has already been adjusted, right, we don't need to report anything for beginning RE as reported. We'll just report the new numbers as adjusted. Again, we'll add the net income number after the adjustment, so with the new change in accounting principle, and then that'll get us to our ending RE for 2014. So in the previous example, we ignored income taxes. If we put income taxes into the equation, this will require us to make an adjustment to income tax expense. Second, since we ignored income taxes before, our increase in net income was the same amount by which our cost of goods sold decreased. If we include taxes, our net income and hence our retained earnings is going to increase by the net of tax amount. But ultimately, since cost of goods sold is not affected by our income taxes, inventory will be the same. So if you remember before, we debited our inventory and credited RE for 200. This was the cumulative effect on cost of goods sold. Right? Again, so this entry here was ignoring taxes. Now, if we assume a 30% tax rate in this case, again, inventory is not going to be affected by taxes since cost of goods sold isn't affected by taxes. So we're still going to debit inventory for 200. Now, retained earnings increases by the net of tax amount. So we'll take 30% out of the $200 increase. And then the decrease in RE is, or the decrease in RE relative to no taxes, so the $60 decrease is the amount of taxes that the company will have to pay on it eventually. So they will credit their DTL for that $60.